The cycle that I saw was brought about by seeing three important forces that I hadn't seen in my lifetime before, but happened many times in history, which is why I needed to study them, that cycle over the last 500 years. First, when governments run out of money, they need more money than they can get. They create a lot of debt, and they print a lot of money, and it debases that money. We have had the largest debt increases and money creations, particularly in the leading world's reserve currency, the dollar, although that's been true in the euro and it's been true in the yen too. And that has a big effect. The second of those influences is really a political and social influence, which is the conflict between the left and the right. Populism, often, typically, due to large wealth gaps and opportunity gaps, which exist in the United States now. And so you're seeing a conflict, you're seeing almost a civil war, because as you have populism consists of people representatives who will fight rather than compromise, fight for their way of doing things. And so we have an ideological and economic differences that are also political differences that you could see every day reflected in the news. And you saw become in January 6th that the issue of losing. I think we're in a situation where we can have an election in which neither side accepts losing. And so we see that reflected all the time, such as the Supreme Court ruling on abortion. You see that type of conflict. That conflict, the measures, I like to measure things, is the greatest since 1900. And that also relates to the economic one I touched. And then third, as far as the changing world order, is the relative decline of the United States and rise of China and other countries. India, for example, of course, has improved its position, many countries. So that when the New World Order began in 1945, world orders come after a war, and then the victors in that war determine how things should go. When in 1945, when the United States won the war, it was the richest country in the world. It had 80% of the world's gold, and gold was money. And it had half the world economy, half of world GDP. And it had a monopoly on the military power, and it was the dominant world power. And that's why we have the United Nations in New York, the IMF and the World Bank in Washington, D.C. And that relative positioning, there's been a decline in that relative positioning and the emergence, particularly of China, as a great power. And so there is a great power competition taking place. And traditionally, through history, that is resolved by conflicts. So we have 5 different kinds of wars that happen, and we're seeing them now: a trade war, a technology war, a geopolitical influence war, a capital war, and a military war, possibilities. So that confluence produces these difficult periods. The last one was 1930 to 1945, and that's what we're in the midst of. So it's very important for me as a global macro investor to understand those. When there's a lot of debt, since a debt is somebody else's asset, it's a financial asset that's being held. The more of that there is, the more difficult it is for central banks to balance that, to simultaneously have an interest rate that is not too high for the debtor and also adequate for the creditor. And that's why it's very difficult. And we're also in an environment in which there's a great desire to spend a lot more than is earned. That's why we have big deficits. Very little attention is paid to whether there's enough money to do that, because money can be produced. So what we see is the dynamic of governments, central governments, borrow the money, but they borrow it from their central banks who print the money, and that devalues the money. So that creates a cycle, a paradigm shift. Paradigm shifts happen about every 10 years, and they create from one paradigm to a new paradigm. One paradigm is one type. So, for example, the 1920s led to the 1930s, or the 1960s, which were very different, led to the 1970s, which were the opposite. So we are in an environment in which there needs to be large deficits, large spending, and the printing of money, which then devalues money in relationship to goods and services and in relation to investment assets. And that starts to cause this paradigm shift, because most investors and most people are not used to inflation in the same way. So, for example, investors think that their safest investment is in cash, hold cash. But cash deposits, which they think is safe, is probably the least safe investment, because it provides an interest rate which is so much below the inflation rate. So, for example, in the United States, virtually a zero interest rate when the inflation rate is over 7%. So there's a 7% loss in buying power. So that creates that realization that they're losing buying power, causes them to sell those assets and to put the money into something else. And that worsens the imbalance. Inflation psychology and inflation forces, when it gets into the system, also causes other adaptations that produce inflation. For example, employees want to know that they're inflation protected in their wages, and so you see it reflected there. Or there's the purchases of assets, inventories for companies or houses, residences. There are purchases of those because they're inflation hedged, which causes those things to rise. So we are in a shift from one paradigm to a shift in another paradigm. And there's a necessity for that, because if they don't print that money, then they don't get to spend the money. Like if there's a social consequence right now, big wealth gaps. And if you have large wealth gaps at the same time as you have bad economic conditions, then there's the printing of the money. So central banks try to balance that inflation and growth. They try to get, the lowest inflation, not below zero, but low inflation, and they try to get strong growth. And so there's always that balance. And the balance now is going to be much more difficult, because so we've entered a period of stagflation, because there's all these debts and financial assets, and it's very difficult to balance that. So that's the kind of environment we're in, a stagflation type of environment, and with a lot of conflict between different interest groups. The most important thing is to not own debt assets which are subject to inflationary pressures. It's not, if you're buying an inflation indexed asset, that would be fine. They're inflation index bonds, but to not own assets which will lose their buying power because there's a lot of debt and has to be printed. The second is to create a diversified portfolio of assets, a well-balanced. If you diversify well and you look at the correlations between asset classes, you'll see that one thing goes up, another thing goes down. For example, during times of greater inflation, you see commodity prices, gold, real estate prices. You see those types of assets perform better at the expense of other assets. And also the stock market has parts of the stock market, these different stock markets, which are not primarily going to be hurt by investments. There's many that benefit by inflation. So to create a diversified portfolio, diversification is of paramount importance because it is the way that you can maintain a good return without as much risk. In other words, for example, if you pick investments that have about the same expected return, but they're not correlated, and you put them together well, you can reduce up to 80% of your risk without reducing your return. So how to create good diversification is very important. That includes country diversification. All the currencies are now fiat currencies. The dollar, of course, is the leading world's reserve currency. They are related to each other. No country wants, in this environment of relative depression or relative lower prosperity, no country wants to see its currency go up too much. So the fiat currencies, there tends to be a fair amount of printing of money and then a lowering of that. We are in a temporary period that I would say will probably last 6 to 12 months of a tightening in monetary policy, but that will be the correction in the trend. That tightness will produce weakness in markets, to be followed by weakness in the economy, to be followed by another round of easing. So I want to be clear, the printing of money and the large debt will have a correction as there is this tightening coming up, which will be probably over the next 6 to 12 months, but you'll have that. So as a storehold of wealth, and by the way, they won't bring interest rates during that tightening to a level that will compensate for inflation. So you'll still lose money to inflation, which it means it's still better off in those inflation hedge assets. When we look at the currencies, we're used to looking at them in relationship to each other, but they all have that issue. Then there are non-currency, non-fiat. Gold is an example of a non-fiat currency. Then, of course, we have digital currencies, which are newly developed, and that's a non-fiat currency. I think we've entered a period of time over the next several years where the world is going to be looking for what is an acceptable currency, and it's going to be confusing. And so these currencies will compete with each other. There'll be less attention to fiat currencies and more attention than to others, but still, of course, the dollar will be important. And then you will see the renminbi become a much more important currency competing because of a few things. Throughout these arcs of the cycles, I studied the last 500 years, and I found the Dutch guilder and the Dutch were the first reserve currency in the 500-year period. followed by the British, followed by the American, and so on. And you see how that happens. As the country gets richer and becomes the largest trading country in the world, larger percentage of world trade, they carry their currency with them. And so it becomes a medium of exchange and a storehold of wealth. And countries and people, therefore in other places, want to save in that currency. And so that's why it's popularly held as savings. That saving takes the form of lending to the reserve currency country, and it contributes to getting more in debt. And then as they become a lesser share of world trade, with a significant lag, the currency loses its reserve currency status. China now is the largest share of world trade, a largest amount of capital flows outside, so it competes effectively. The Chinese have chosen not to internationalize the renminbi until recently. Now they are internationalizing that. By that I mean transacting in it for trade or using it for lending and borrowing. So we are seeing the internationalization of the renminbi, and that'll make it more important. Also, the effects of weaponizing the dollar have a challenge to them, because the US dollar and US capital markets were free globally and free trade, and so now it's being more politicized, and sanctions mean freezing financial assets and the like. And there are greater concerns that can happen as the US imposes sanctions such as freezing dollar assets. And that's also causing money to go into other currencies. Now, what those currencies are is going to be determined. I think that while cryptocurrencies been really amazing in that there were, let's take Bitcoin, and there are two types of cryptocurrencies. I'm sure you're referring to Bitcoin type, in which there is the quantity is contained, as distinct from other types of coins in which there's a variability, such as stable coins or Ethereum. But anyway, amazing that they were programmed and have operated for, I think it's 11 years now, haven't been hacked and so on, and have been acquired. Still, there are issues with them. The total value of Bitcoin, for example, all that money, is less than the value of Microsoft. And so when you think of different storeholds of wealth, it's not very big. By the way, the gold market isn't very big either. It's about 5 times the size if you take out central bank reserves and jewelry. But so they have issues. Transactions can be traced. So the privacy issue is is an issue. So they can be controlled. They can be shut down. They can be made illegal, which tends to happen during times when they may be threats to the alternative currency. So I don't think they'll be held as central bank reserves for various reasons. There's a saying that gold is the only asset you can own that isn't somebody else's liability. In other words, you own it and you don't have to wait for a payment from somebody else. And I think that as the environment that we're in is an environment in which there is a risk of political confiscation or other forms of confiscation, I think that gold does a better job. But as I say, we're into this new environment, and that could include NFTs, could include all sorts of things. That is it something that you can carry with you and that you can transact almost anywhere in the world because somebody will buy it. It's equally acceptable in most places, ideally private, if you can find those things. So it's a competitor, but I think in terms of its qualities, not as good a competitor. I think it's a mistake for anybody to have just one, such as picking a digital currency as this thing from and not having any gold, or not having any gold, or just having just gold and not having any digital currency. But we'll figure those things out. It'll evolve over the next 5 and 10 years a lot. Gold, let me tell you about gold as a generalization. Gold has a return, normally it's low returning. It is a dead asset. It is a beautiful, limited supply, dead asset that is money. Unlike, let's say, equities, in which there's constant invention and productivity. So, but it's very important to own at some times. At other times, it's just going to be a dead asset. And those times are these times of a lot of debt and money creation, and times of conflict, times of wars. In wars, even allied countries don't want to lend to the other country because everybody's getting in debt, and so they'll be paid back with a depreciated currency if they win the war. So I believe that this environment that we're in is an environment which is good for gold, and therefore it should be a significant part of the portfolio, but not a dominant part of the portfolio. What that might mean is maybe 15% of the portfolio. That would be, quite a large allocation, but under today's circumstances, perhaps, as much as that. And then there should be other assets that diversify the portfolio.
Ray Dalio is an inspiring billionaire investor, hedge fund manager, and philanthropist. He is the founder of Bridgewater Associates, the world's largest hedge fund, which he started in 1975. He has been widely recognized for his innovative investment strategies, which have earned him a reputation as one of the world's greatest investors. He is also an advocate of the principles he developed, which are a set of unique and practical life and business principles. He has an impressive track record of success, having founded Bridgewater Associates in 1975. Since then, he has grown the company to a staggering $160 billion in assets under management. Ray Dalio has been widely recognized for his innovative investment strategies, which have earned him a reputation as one of the world's greatest investors.